Welcome back. The price of oil has fallen about 1% so far today. Saudi Arabia has offered to make up for oil supplies lost because of the revolt in Libya, reasserting their willingness to do so. Still, oil hasn't been trading at these levels in more than 2 years' time. Here with more is Larry Kantor, a well-known bull and head of research at Barclays Capital. He's also a former Fed economist. Larry, thanks for joining us here. I'm going to start with the question that I bet you Ben Bernanke is going to get over these next 2 days, and that's how high do oil prices have to stay before we really see a shrinkage in growth?
Well, I think it's impacting the consumer right now, but it's important, I think, to put this in perspective. Oil prices were trading around $80 a barrel when everybody was worried about double dip. As the economy accelerated, moved up to about 90. And now we're in the sort of 95 to 100. So it's actually the first step up of $10 was because growth was stronger, not just in the U.S., but all over the world. And this turmoil in the Mideast has taken it up another $5 to $10. Now, this does have a restraining effect. But in a way, given how strong the markets have been and how solid the economy is starting to look, this may not be a bad thing at the end of the day. You know, if you look at the stock market, for example, you're talking about a correction of not even 3%, and this is after moving up about 25% since late August, when everybody was worried about a double-dip recession. So at this point, I mean, and the key is, the other thing to put in perspective is, you know, if you look at Libya oil production, it's about 1.5 million barrels a day. It's estimated that OPEC, mostly in Saudi Arabia, has spare capacity of close to 5. So, you know, this doesn't have to have a huge impact. We have seen, as you know, gasoline prices move up. That has a big impact on consumer spending in the U.S. We just had a 4% increase in real consumer spending in the fourth quarter. It's almost sure to be less in the first quarter, and one reason is higher gasoline price. So it is providing a moderating factor. But at this point, and as long as this thing doesn't get into countries like Saudi Arabia, this is not a thing that's going to kill the recovery or kill the markets. Well,
that's why we're watching the unrest in Oman and other parts of the Gulf, because of exactly what you said. But is it a 6 to 9 month period that it really takes for real, you know, handcuffs on growth?
No, it doesn't. It's in the U.S. This is one of the, you know, the higher crude oil prices translates very quickly in the United States to gasoline prices, more than almost any other country. And it hits the consumer immediately because, as we know, that's considered a necessity in the United States. And when people are paying more money for gasoline, they have less money to spend on other things. So it's almost like a tax, because it's, you know, it's not very elastic. In other words, they don't start filling up less. They just spend less. And so it happens very quickly, even within weeks. So you're seeing this now. Now, part of the effect, you know, in terms of looking out what this means for the Mideast, is how fast it happens. So, you know, for example, from 2003 to 2007, oil prices went from 30 to 80, which is a massive move. But because it occurred over 4 years, we had very rapid economic growth. If it jumps in a month or two, it really hits very hard, and you see a real collapse in economic activity. So at this point, if it's contained, and one thing that's, you know, makes you feel a little bit better is countries like Saudi Arabia have a lot less people than countries like Egypt, and much more oil wealth to spread around to people, which kind of keeps the peace a little more. So hopefully it doesn't spread into the real big oil producers.
Well, let's talk about some of the support mechanisms in there. I mean, the Fed has bought, what, $230 billion of $600 billion worth of bond buying through QE2. Do we see QE3? Do we even start talking about that at this point?
No, I don't think so. In fact, I question whether the Fed would have even embarked on QE2 had they known that the economy was going to reaccelerate anyway, and that the government was going to throw in a whole bunch of new tax cuts, like the payroll tax cut and the investment tax credit and all the rest. So we've got a confluence here of an economy that was picking up anyway, and we know this because it started picking up before the effects of QE2 and the new fiscal stimulus and all this new stimulus. So you should see, you know, very solid growth in excess of 3% in the first half of this year, could even be 4%. So, this is occurring against a pretty solid economic backdrop in terms of growth, not levels. We're still at weak levels of economic activity. We have high unemployment rates, but growth is really picking up. And luckily, we've got some spare capacity in the oil market at this point to make up for the loss in oil. So at this point, again, I'm not a political expert, and we all know this could spread way beyond the smaller countries like Libya, and Egypt's not even an oil producer. And then we're talking about much bigger effects. But at this point, when you're talking about oil prices around $100, given how fast growth is, that's not going to kill things.
All right, Larry, thank you very much.